I just thought it was naive, like, oh, geez, government price fixing. Yeah, that's dumb. Ha ha. Good thing Friedman came along. All right. So I don't know if he was making it sound like his opponents in the debate among economists in the early 70s or late 60s and early 70s was just that simple, or whether I just missed it because I was in high school. Okay. But what I'm telling you, the InFi viewers now, is don't make that same mistake I did. That when Arthur Laffer in that clip, or if you read historically about how under the classical gold standard, there was a fixed exchange rate system. And then people might say, oh, and then it broke down. And again, Laffer, as you saw there, saying that, no, it worked fine for centuries. It was deliberately sabotaged. What do you mean it didn't just break down?
Welcome to InFi, the future of finance.
Hey, everybody, welcome back to the InFi podcast. Today, I'm going solo again, and I'm going to explain the distinction between fixed versus floating exchange rates, and specifically having to do with when countries were on the gold standard. That's where this comes from. And the motivation for me getting into this is I recently saw an interview by the Hoover Institute with the economist Arthur Laffer of Laffer curve fame, if you've heard of that. And so here, let me go ahead and play just a snippet from that interview just to motivate what I'm going to get to in this episode here of InFi. In case you're saying, geez, do I want to devote 45 minutes of my life to this? The reason it should interest you is if you care about money and banking, right? That this will give some insight into how the financial system used to work. And again, I think there's just some terminology that gets thrown around and people don't understand how things used to work. And I don't believe that I've gone through all of this stuff, this material here on the InFi podcast. So specifically, if you're interested in this stuff, I would point you to a book that I know I've pointed to before, namely my book, Understanding Money Mechanics, that's put out by the Mises Institute. You get a free PDF or EPUB version if you prefer, so you don't even have to pay for it. So I'll put links at the show notes page here. Okay, so all the stuff I am going to summarize here, I go into in greater detail in that book if you're interested in following up on this stuff. But again, I think this is useful, especially as we get into certainly, cryptocurrencies and also like how stable coins kind of function as banks, at least economically speaking, that all this stuff is related to standard economic theory in terms of money and banking. And so it's good to just know the basics of this. All right. So here's a clip from the interview of Arthur Laffer.
So I guess this is my question for you. So you're working at UChicago, you're working at OMB, you're working with Schultz, going back and forth between Washington. You were there at Chicago in the late 60s. And around that time, you're hired as an international economist.
Yep.
And I'm sure at that time, my guess is you were probably in the same seminars as Harry Johnson, the famous...
Bob Mundell was the leading international economist of the world back then. I worked with Mundell. It's the Mundell-Laffer hypothesis. It's all the stuff we worked together. He was my primary thing. Very big fan of Ron McKinnon's, both of them Canadian, both of them the same economics. He loved my training with Emile Desperry and Ron McKinnon. And we did tons and tons of work together. He took me
all three of them were Canadian. Robert Mundell is Canadian, Harry Johnson Canadian, Ron McKinnon Canadian. And some people would argue that, part of what inspired the Mundell-Fleming hypothesis or conjecture and trilemma was the fact that Canada was actually the first sort of break off from the Bretton Woods fixed exchange rate system in the 50s and to float briefly before they went back.
It almost got killed.
And that sort of influenced Mundell to start thinking about, should we have a fixed exchange rate regime, floating exchange rate regime? Mundell and Milton Friedman had obviously this, very big debate in that time.
Well, we were all fixed exchange rates. We were gold standard people. Mundell and I and Paul Volcker in there. And Milton Friedman was floating rates. And just for the record, floating rates don't work. They don't work.
It's a debate that still goes on to this day.
But it shouldn't.
Yeah, well, the end, I guess, of Bretton Woods and the breakdown of the fixed exchange rate system, it's ushered in this...
The fixed exchange rate system didn't break down. The fixed exchange rate system was demolished by sabotage.
Yeah.
We had no problem with a fixed rate system for 3-4 centuries before 1913. It did really well. And it did the monopoly of government and then floating rates did really badly post 1913. And it ended up squirrely as all get out. We almost went back to fixed rates with Reagan. We came very close.
Well, there was the Gold Commission, Schwartz kind of led, and there was a bit of a revisiting of some of these things.
Oh, a total revisiting, and Reagan was a hard money person, as was Paul Volcker. Paul Volcker was gold standard all the way.
Volcker wanted a zero for his entire life, wanted a 0% inflation target. Volcker.
Me too. Mundell too.
Why? I guess everyone's why 2% over long periods of time? It's a lot of inflation, but they should have 0%. Said was the argument. I mean, was it Friedman who was pushing back and fighting for flexible
100% Friedman
exchange rates, and who won over Reagan in that?
It was 100% Friedman through George Shultz that got the Camp David to go to floating, go devalue the dollar, go off gold, and to have the Smithsonian Accord where you had a floating rate. 100% Milton Friedman. Now, there were a lot of other economists who agreed with him, but he was the push. He was the one with George who convinced George to get in there and get the president to go along with it.
Let me mention, just in case it affects your opinion of what happens, I should disclose that I used to work for Arthur Laffer. Okay, not that what I'm going to say is going to be particularly tied to what he just said there, but again, that's the jumping off point. So let me just unpack what he was getting at there. And what's interesting is this issue of fixed versus floating exchange rates and how Milton Friedman was a fan of floating rates. If you go read, I forget which, it might be like in Capitalism and Freedom, but there's like a pop collection of essays by Milton Friedman that is supposed to be accessible to the layperson. And so I remember when I was first getting into free market economics and I got that and I was going through it, and one of the essays or chapters was Friedman's argument as to why governments should allow for floating exchange rates among their currencies as opposed to fixed exchange rates. And the argument that Friedman made there was like, hey, in general, economists know that price controls don't work. And so like if there's some, I'm here paraphrasing, but this was certainly the spirit of his argument. And just like, if they put a price floor on apartments, what happens is there's a shortage, right? That more people want to rent apartments than there are units of apartments to go around. So there's a shortage. On the other hand, that's a price ceiling, what I just said. They put price ceilings on apartment rents. They don't let them go up to it. The flip side, what if they put a price floor on the price of labor, namely a minimum wage, so you can't pay lower than a certain amount? Well, then there's a glut that more people want to work than there are employers who want to hire them. And so there's unemployment. Okay. So that's how, economists in introductory econ classes would explain the problem of price fixing when it comes to apartments or unskilled labor. And so Friedman said the same logic applies to currencies. And so if there's some tin pot dictator somewhere and he's running the printing press, paying his troops that way, and there's rampant inflation in his country, and so his domestic currency, that he's inflating, is falling against the major currencies of the world. It's falling against the dollar and the yen and so forth. The euro didn't exist back when Friedman wrote this essay. Well, the dictator might not like that. That might be an affront to the esteem of his country. That might make his policies look bad if his currency is rapidly depreciating. So he might come in and impose a fixed exchange rate. He might say that, you're not allowed to trade our currency for less than such and such against the US dollar. And if we catch anybody selling our currency at a lower exchange rate than the one we just announced, than the official rate, you get a huge fine or you go to jail. And you can certainly go ahead and do that and impose a price floor on the country's, exchange rate vis-a-vis the dollar and the yen and so forth. But what's going to happen is you're just going to cause black markets and shortages of dollars and things like that, right? That there's going to be a glut of the domestic currency and a shortage of the dollar and the yen and so forth. And that the only way people will be able to get dollars and yen in that dictator's country is if they go to the black market and they pay more units of their currency than the official amount that's allowed in order to get dollars and yen. But officially, nobody can get them because foreigners are not going to transfer in dollar and yen assets for the official rate because they know that's not the market rate. Your currency is worth as much as your government says it is. All right. And so in that context, then Friedman is saying that's why we should have floating exchange rates on the Forex markets, and currencies should be allowed, just let supply and demand set the exchange rate. and government shouldn't be involved in trying to pick one particular exchange ratio of currencies against each other, just like we don't want them fixing the price of wheat or fixing the price of unskilled labor, or at least putting down, a floor. So that seems pretty straightforward. And yet the context in which Arthur Laffer there is talking about, oh yes, he and others were in favor of fixed exchange rates, whereas Friedman and his group were in favor of floating exchange rates. And in the fateful day of 1971, when Nixon, quote, went off gold, what that effectively meant was he decoupled gold from the US dollar such that the gold price now could just float and just be whatever the market supply and demand said, as opposed to being locked into, at the time it was $35 an ounce was the official dollar price of gold. So you might think, oh, so I guess Milton Friedman was being consistent in a free marketeer, whereas, geez, that's kind of funny. Arthur Laffer and his crew were in favor of government price fixing back then. That's unexpected. And no, because that's not what those terms mean. So here, I don't know enough about, I would have to go reread Friedman's essay. Because in other words, when I was in high school, I think probably is when I first read that thing, or maybe I was like a freshman in college. And at that time, I did not understand the context of what it meant when various countries' currencies were tied to gold, and that's what the fixed exchange rate regime meant. I just thought it was naive, like, oh, geez, government price fixing. Yeah, that's dumb. Ha ha. Good thing Friedman came along. So I don't know if he was making it sound like his opponents in the debate among economists in the early 70s or late 60s and early 70s was just that simple, or whether I just missed it because I was in high school. Okay. But what I'm telling you, the InFi viewers now, is don't make that same mistake I did. That when Arthur Laffer in that clip, or if you read historically about how under the classical gold standard, there was a fixed exchange rate system. And then people might say, oh, and then it broke down. And again, Laffer, as you saw there, saying that, no, it worked fine for centuries. It was deliberately sabotaged. What do you mean it didn't just break down? It was abused, okay? It shackled the governments, and they didn't like it. They wanted to be able to print money to pay for stuff, and the gold standard didn't let them. And so that's why they got rid of it. It's not that it failed to do its job. It was doing its job too well in that sense. Okay, so the best way to show the distinctions, let me just give you a numerical example. So back in the classical gold standard era, and as I spell out in my book, it's particularly chapter 2 of my book, Understanding Money Mechanics. It's chapter 2 where I give a brief history of the gold standard with an emphasis on the US. But so that's really all you got to read for the stuff I'm covering in this episode. You don't have to read the whole book. But anyway, what we call the classical gold standard era it's not like one conference or something just made it happen. It was over time, more and more countries started going towards gold. And then it was sort of like a snowballing process that as more and more countries tied their domestic sovereign currency to a fixed weight of gold, then it made it more advantageous on the margin for other countries to do so, right? There were like network effects. And so early on, like the United States, as far back as 1792, there was a coinage act that had a bimetallic standard. So the US dollar was defined in terms of certain number of grains of silver and of gold. Okay. And so that what you would do is you would go to US authorities with a certain amount of raw silver or raw gold, and they would stamp it into coins that were official US coinage. And like a $10 gold eagle had to have a certain amount of gold in it, and like a $1 silver US coin had to have a certain amount of silver in it in terms of weight. And then they could have a $quarter, so that was 25 cents a quarter, and so on. Okay, so that's how the dollar was defined. And then I'm just saying, eventually the US dropped the silver part. So it's what they call demonetized silver. And so from that point forward, it was only gold. Okay. So I'm saying in the mid 1800s, more and more countries were doing that. And then it just kept snowballing. And then by the late 1800s, more and more. And then the early 1900s, it just kept snowballing, such that on the eve of the First World War, all the major powers and plenty of other minor governments around the world all defined their national sovereign currencies as a fixed weight of gold. And that's what we mean by the classical gold standard. And that was pretty robust. I want to be clear. It wasn't merely that the authorities could just print paper currency, like the US dollar or the Bank of England printing up notes or pounds, or the Banque de France printing up francs. It wasn't that, they had pieces of paper that were like the official notes of those governments, the currency, and they just promised, we're going to try to make this rotate around or oscillate around some price of gold. Like they weren't just targeting the price of gold measured in their currency, which is maybe nowadays what you would think. Like if the Fed came out and said, hey, we're targeting a price of gold of such and such, and that's the way we're going to conduct monetary policy. The Fed could do that in principle, but I want to say that's not what we mean when we talk about the classical gold standard. Back then, the way it worked is you would bring in the actual gold or silver to the authorities and they would stamp it into coins, official coins. So the money, the official lawful money wasn't just pieces of paper. It was actual coins that had gold in them. And also you could take those in and melt them down into gold too, and just get the raw gold if you wanted. And then if people had, like if the US government owed people money, right? Like if they had floated bonds and then owed somebody, whatever, $1,000 US, you could get paid in gold coins if you wanted. Okay. So that was the sense. And so notice there, it wasn't even that the authorities in that system decided how many dollars they're going to be. That was endogenously determined. If that's a fancy economics term, that just means that wasn't something that the authorities picked. It was a result of the system, of the framework. The framework was people can bring in as much gold as they want and we will stamp it into US dollars at the rate of $20.67 per ounce of gold. Okay. And so, and that's the way it worked. And then anybody around the world who had dollar claims on the US government could say, you owe us gold. All right. So, and then I should also say briefly, there were paper notes that were like that Americans would walk around and say, oh yeah, I have $5, and it'd be like a paper note. But before the Federal Reserve was established, those paper notes were issued by private commercial banks. I mean, they could be state chartered or whatever, but I'm just saying the US government per se was not cranking out paper notes that were called dollars. They did during the Civil War. You might have heard that, called greenbacks. All right. But in general, it was banks who issued paper notes that could be redeemed for the underlying like legal, lawful money, which were gold and silver coins. And then just gold coins, after silver was demonetized. Okay. So that's how the system worked. And so now finally, let's back to the question of the fixed versus floating exchange rates. So in that world, so for example, on the eve of the First World War, the US government, as I said, it defined the dollar as a certain weight of gold, such that if you did the arithmetic, it worked out to an ounce of gold was worth $20.67. And likewise, the British authorities, they defined their monetary unit such that 4.25 British pounds were equivalent to an ounce of gold. Okay. So now if you just do the arithmetic, that works out to $4.86 of US currency is equivalent to 1 British pound, right? Just 20.67 divided by 4.25. Okay. And so that was like the anchor point. And so you could say, oh yeah, in the classical gold standard right before World War I, that the fixed exchange rate system implied that in the foreign exchange markets, 1 British pound should trade for $4.86 of US money. But I want to be clear, that wasn't price fixing in the way that Friedman's essay would have led you to believe. That's not analogous to some petty dictator somewhere imposing capital and currency controls on his country and saying, oh yeah, we're going to artificially prop up the value of our domestic currency. And, you financial speculator, you're not allowed to short our currency against other ones. No, that's illegal. We catch you doing that, you're going to jail. The way that anchor price of $4.86 per British pound was maintained was not because if it deviated, you'd get in trouble. It's because there were incentives, there were arbitrage opportunities, given the fact that the U.S. authorities stood prepared to say, if you turn in dollars, we will give you gold. And the same thing with the British authorities. All right. So if, let's say, the U.S. authorities issued too many dollars, well, then people could turn them in, get gold, put it on ships, ship it across the ocean, give the gold to the British authorities, get British pounds for it, and then take the pounds and go in the foreign exchange markets and obtain more dollars than they started out with. Okay, so here I'm going through quickly just to make the point, but in the book, my Understanding Money Mechanics, I walk through like the numerical example more carefully and just show you exactly why that would be profitable, right? And so the idea is a particular country that's creating too much of its own domestic currency back on the days of the classical gold standard, such that that currency weakens against some other major currency below like the anchor point that's implied by their gold standard ratios, that would set up an arbitrage opportunity. So people would present that overvalued currency to the issuer, get the gold, ship it to the other people whose currencies were relatively undervalued, get more of that currency, then go in the foreign exchange markets. And again, so you end up with more of that original currency that you started with. So that's why you would do it. So people who started out with 10,000 US dollars would end up with 13,000 after doing all that stuff for a 30% return. So that's why they would do it. But what that did in practice, if you think it through, is that the countries that issued too much money, they would have a run on their gold reserves. People would present that money to them and say, yeah, give us the gold at that official rate that you promise. And then they would ship it over to the countries that had been more responsible. Okay. And so that's what happened in the days of the classical gold standard, that the system kind of kept all the participants relatively honest. That if any one country inflated more than its peers, there would be a net outflow of gold from its vaults into the vaults of all the countries that were relatively more moderate in how much they were inflating. Okay, so that all broke down in World War I, where all the major countries except the United States just completely abandoned their promise and said, yeah, we're not redeeming our currency for gold right now. There's a war on. And why they do that? Because they wanted to run the printing press and pay for their troops and munitions and whatever. Okay, so that's what killed the classical gold standard, was World War I. But I'm just explaining that's how it worked. And so for our purposes here, again, you see the difference there. To say that, oh yeah, on the classical gold standard, the fixed exchange rates implied that $4.86 of US money would trade for one British pound. It's not that if somebody tried to offer $5 for a British pound, that the US authorities would punish them or fine them or put them in jail. It's just, why would you do that? You don't have to do that. That's silly, right? You could just do some movements of gold and things and other transactions that you could get British pounds for $4.86. There's no reason to pay $5. Okay. And vice versa, that if for some, it would never be the case that you'd be able to get British pounds for only $4 US, because then that would imply people on the other side of the transaction were selling pounds for less than they needed to. Instead of selling for $4, they could do the transactions and effectively turn their British pounds into $4.86 of US. Okay. So that's kind of how it worked. All right. So again, it wasn't typically, when we think of price controls and why they cause shortages or surpluses or gluts, it's because what we have in mind is the government says, if we catch anybody deviating from this official either floor or ceiling, we're going to punish you. But in the context of currencies and what Arthur Laffer is talking about there, where he talks about fixed exchange rates, no, what that means is the government's promise. They constrain themselves. They say, we promise that we stand prepared to buy back and redeem our currency at a certain redemption rate relative to gold. And so you notice that that's not imposing limits on anybody else. That's governments adopting a rule that constrains their own behavior. It's just them announcing we are going to follow this procedure in how we conduct ourselves. Okay. And so that's why it doesn't cause shortages or gluts out there in the real world, in the marketplace, because it's just how governments operate. Okay. So that's the basic point I wanted to make. And again, as you saw, Laffer was saying this system, it's not that, oh yeah, it just kind of broke down and we got to unshackle prices so that they can be free and let supply and demand that. No, you were letting supply and demand work. It's just that before, under the fixed exchange rate system, all the governments of the world had this constraint on them. And that's why, as Laffer was saying, that when you as a government have a constraint like that, over the long term, your prices are relatively stable. So in the United States history, over long stretches, the purchasing power of the dollar was roughly constant. Like the amount of stuff you could buy with dollars in the year 1800, like if you had $100 or let's say you had $10 in the basket of goods that you could buy in the year 1800 with $10 was roughly equivalent to what you could buy with $10 in the year 1900. It wasn't identical, and it gets tricky because there's new things introduced and whatever. So what does that even mean to talk about the purchasing power over a 100-year stretch? But by and large, it was roughly constant. It wasn't constant throughout the whole period, but from one endpoint to the other. So in between, like during the Civil War, the purchasing power of the dollar fell, meaning prices in the United States quoted in US dollars went way up. But then after the war, there was price deflation. Right? Over time, prices fell such that they went back to their pre-war parity. Okay, because what happened is during the Civil War, they suspended what's called specie redemption, right? So the US dollar was not redeemable for gold during the Civil War. And then afterward, it wasn't either, but then they passed some legislation to say, we will return to full redeemability at this date. And they started like sopping up excess dollars to move toward that feature. Okay. Whereas nowadays that doesn't happen. If there's too much inflation, like what happened after COVID or during and after, they printed up boatloads of money, prices rose, the public was outraged, so they backed off. But it's not like prices are going to go down for the next 10 years to get us back to the pre-COVID baseline. They just mean, okay, the increase in prices is going to be much more moderate going forward. But, that whole upswing is still largely there in general. But no, during the 1800s in the United States, that wasn't the case. There could be upswings in prices like during a major war when they would relax the tide of gold, but then they would go back and restore the gold standard gradually. And so they had to, prices had to fall to make that possible. So the intuition there, just if you think about it, if the dollar is defined as a certain weight of gold, well, then what that means is ultimately the quantity of official dollars isn't going to expand more than the quantity of gold in circulation. So that's kind of the way to think about it. And so, there can be, you might wonder how come prices just weren't falling constantly. And that's something that I think sometimes people in the free market community get a little bit off. Like, there's technological innovations and every year we produce more stuff. And so you'd think prices would fall over time. Now, that would be true with something like Bitcoin, right? If the quantity of money is just fixed and then real output goes up year after year so that we get more cars produced every year than before and more sweaters and more eggs and so forth. If there's a fixed quantity like 21 million Bitcoins period, once it maxes out, then year after year, yes, you would expect the price of things measured in Bitcoins or Satoshis would go down gently. And that would be fine, by the way. That's not like that would cause some problem. If people saw that coming, they would write contracts and so forth and anticipate that's fine. But I'm saying if instead you have a unit of currency that the government defines and ties it to gold, well, more gold keeps entering the market year after year. Some of it gets used up for industrial purposes or flows into jewelry and things. Even there, you could melt it down and turn it into coins if you wanted to. Whereas only some of that output gets diverted into being held for monetary purposes, gold bars held in vaults or coins that are held by people. But still, the quantity of gold being held by the public as money or as a monetary type of asset in our time, that still goes up over time. And so that would partially stop the prices of things measured in gold from falling as fast as they otherwise would have. So I guess what I'm saying is Bitcoins are going to max out at 21 million unless they change the protocol, whereas the quantity of gold coins or weight of gold held for monetary purposes around the world is going to just keep increasing for a while, at least, right? There's lots of gold that's still on planet Earth that they haven't yet mined. Okay. So that's how it works. And so last thing is, as Laffer said, that system worked fine. The social function of money, and I get into this in my book, Understanding Money Mechanics too, is that it helps facilitate trades and it lets people engage in what's called economic calculation, right? Like by having a common unit of account for everything, one good that's on one side of every transaction, that greatly facilitates economic planning. Okay. And you can't do that as effectively if, number one, if there's lots of different monies that everybody's using, because that's almost equivalent to barter. And two, even if everyone is using one money, if its purchasing power is real volatile, then it also isn't as effective. All right. And so the point is gold in the classical heyday served a very important function and did the job very well. The last thing I'll say is there's a sense in which the whole world is just using one money, even though the Americans used dollars and the French used francs and the Germans used marks and so on. As of 1912, effectively, all the major economies were all using a common currency, namely gold. Yeah, they had their particular names, but they were all on a fixed exchange rate so that somebody who was getting raw materials from one country, having them combined with labor and manufacture, to create manufactured goods in a different country, and then take that and put it and sell it into a different country where it was marketed. And so even though there were three different currencies at least involved in those operations, because of the fixed exchange rate system, you could do all your calculations in terms of gold, or you could do it all in terms of your domestic currency, but the exchange rates with the other countries, you could predict. I guess my point is people engaging in international transactions had to worry about all sorts of things, but they didn't have to worry about exchange rate risk or what you call currency risk, the way people today do. That was just, no, that you could plan on that, yeah, my country's currency is always going to have the same exchange rate versus my neighbors in the US and blah, blah, blah. And so that just made it easier to engage in long-term economic planning, which is, again, part of the function of why do we use money at all. So nowadays, with governments having fiat currencies that aren't tied to anything and having floating exchange rates, again, it's sort of getting away from the purpose of having money. If every individual had his own money and was the only person who used that, really, then that's kind of like being in barter. Like that's not that. No, for money to be money, it's got to be something that a bunch of people in a community all use that one thing. All right, and so maybe with Bitcoin or other cryptocurrencies, maybe we're going to get back to that. But for now, we're far from that ideal. And I think we lost a lot there. All right, well, that's where I'll wrap this one up. Thanks for your attention, everybody. See you next time.